Okay, let's get started. Good morning and thank you for joining us for today's free webinar, What Startups Need to Know About Taxes, with Glenn McCrae, Chief Strategy Officer at Early Growth Financial Services, and Michael Shaff, Counsel at Stubbs, Alderton. My name is Jenna Cornell and I'll be the moderator for today's webinar. This presentation will run about 40 minutes. If you have any questions as we go through the presentation, please feel free to enter them in the question field. We will answer questions as they come if we can, or we'll wait until the Q&A at the end to address any questions. If we run out of time, we'll follow up with an email after the presentation to make sure that all of your questions have been answered. A video of this webinar will be available on YouTube following the presentation, and all slides are available on SlideShare currently. Glenn and Michael have a lot to cover today. We want to make sure we have time to answer all of your individual questions. So let's get going. Good morning, Glenn and Michael.
Good morning.
Good morning. This is Glenn McCrae. As Jenna said, I'm the Chief Strategy Officer at Early Growth Financial Services. It's a beautiful day here in the Bay Area. Thanks for joining us on our presentation. Our firm is an outsourced financial services firm. We work with small to large companies across the U.S., but primarily we're focused in the San Francisco Bay Area and servicing tech companies.
Michael Shaff with Stubbs, Alderton, and Markiles. We're in Sherman Oaks and Santa Monica, California. We're sitting in Santa Monica right now where it's an overcast day. Our firm is a business-oriented law firm. We have a very good corporate department that's focused on intellectual property, entertainment, and software industries. We have a public securities and M&A group, and we've added very recently an intellectual property and intellectual property litigation group. Ready to go?
Okay. Basically, what we're here to tell you about is the kinds of things that you need to think about when you're running a business. So our clients are usually small, and they're just getting their feet underneath them as a business organization, and they're trying to get their hands around the things that they really have to worry about. We all know that as startups, you'd like to focus on what kind of things you need to do to get traction for your business model. You may be thinking about fundraising, you may be thinking about just what kind of technology issues do I got to come to grips with, how am I going to get customers, how am I going to build content. Very often the last thing you want to worry about is taxes. But that's one of the things that when you're running a business, you need to be thinking about, because you don't want to be running afoul of the different regulatory organizations. And the organizations that are out there that you should be concerned with are across the board between federal, state, municipal, sales tax authorities. All these kinds of agencies have an interest in your business. And we're here to kind of give you an idea about the things that you should be worrying about, the things that you should care about, the things that you might want to check the box and make sure they're taken care of. So as we think about those things that you need to take care of, we can put those issues into about 5 big buckets and concerns. And some of these things may not be applicable to you. If you don't have any revenue at all, you don't really have to worry about sales tax. Income taxes is something that everyone needs to worry about. Once you have filed and organized your business, you could be registered in Delaware as a C corporation. You could also have a registration in the state that you're headquartered in. You have a responsibility for filing an income tax return. Even if you have no income, you still need to file a return. And we can talk about when exactly you have to start the filing process, but generally, if you've opened up a bank account, if you've established any kind of a business presence, that starts with your filing obligation. We're going to talk a little bit about that down the road. Then the next issue is compliance and registration issues. So for those of you who are registered in Delaware as a C Corp or another entity, you realize that you had to file your Delaware. That's something that comes under that category. Then there's other kinds of compliance issues that have to deal with where you're located as a municipal location. So where's your headquarters? Lots of different cities have registration requirements based on the city location. Payroll taxes, that's another significant concern. We're going to touch on that. Compensation issues. There's a lot of things around compensation issues and taxes both for the corporation and for the individual, and sales tax. We're going to touch on all these areas in this conversation today. I think Mike is going to be talking about primarily here the types of entities that we could be dealing with.
Well, just following the slide, the first consideration in choosing an entity is whether it should be a pass-through entity or not. Most startups, I would think, would want to be a pass-through entity, at least until they have venture funding that requires them to be a C Corp. That allows losses and deductions to pass through to investors to the extent that they're actively involved in the business. And it also allows for one level of tax if the entity is sold, which is an important issue. A C corporation, as I mentioned, if your investors are requiring you to be a C corporation, if you're part of a larger group, you may have to be a C corporation. In that case, as Glenn mentioned in the last slide, you'll want to be, you'll start off by filing federal and state income tax returns, even if you have no income, because you want to start to establish something called a net operating loss, which actually is an asset to investors going forward. It protects the company from having to pay taxes going forward. An S corporation allows you to be a corporation if you have the right kind of shareholders, which is 100 or fewer U.S. Resident individuals. It's hard to become an S Corp, and because if you've been a C Corp and you switch to an S Corp, there's a valuation issue and there's potential 2 levels of tax. In addition, the wrong kind of shareholder can cause an S corporation to become a C corporation instantly. In a partnership for tax purposes includes limited liability companies and limited partnerships. They're the most flexible, probably, of all the choices of entities. In a vacuum, I usually recommend use of a limited liability company because it affords the limited liability for investors that a corporation does, yet it has 1 level of tax. If there's going to be an asset sale, that it's just an advantage for the exit strategy, if that's possible. Finally, foreign entities. If you have investors who are foreign entities, whether they're foreign individuals or foreign corporations, it's a different set of concerns, and one that may be too broad to discuss in any depth right now, but it is a factor in determining the choice of entity in whether if you have a foreign investor, they may require that either your entity is a C corporation or that, as an alternative, they invest through a C corporation, which is known as a blocker, so that they're not treated as, if you're a partnership or an LLC, they're not treated as being in a U.S. trade or business that would require them to file tax returns with the IRS, which is something many foreign entities find it's frightening. There are other considerations when there's foreign entities, which, if anybody has any concerns, please shoot them up as a question.
Yeah, I would like to say one thing as a follow-on to Mike's comment about the foreign entity issue, one thing you should be aware of, if you do have a foreign parent or a foreign subsidiary, there is a particular tax form that needs to be included in your federal tax filing, either 5471 or a 5472. You know, we don't like to talk about tax forms, but you should know that there's a $10,000 penalty for failing to file that form timely. So if you do have a foreign parent or a foreign subsidiary, you need to make sure that you are current with your tax filings. So just leave that thought. Go ahead, we can move on. So talking about income taxes, you know, I will just put a comment out there that we have clients who have not filed a tax return for 2012. That doesn't make them bad people. It doesn't make them bad managers. There is not a horrible penalty for failing to file your tax return timely. However, you may have a problem getting a certificate of good business standing if you don't maintain your tax filings. So very often when you're going to do a financing, you're either going to raise debt or raise equity. Part of the due diligence process will be a good business standing certificate from whatever state you happen to be filed and registered in. You won't be able to get that if you're not current with your tax filings. So the corporate deadline is different than the personal deadline. I think almost everybody knows that April 15th is the personal tax filing. March 15th is the filing deadline for partnerships and corporations. You can file for an extension. It's not a hard thing to do. It doesn't cost any money. It's a form that you need to fill out. We do that as a matter of course for our clients. That will get you an extra 6 months to file your income tax return, and it's still considered timely. So that's the first thing. It's just filing your tax return. Next is the concept of tax credits. There are things in the tax world called deductions, and there are items called credits. The difference between a deduction, so let's say that you have a meal that's a business meal. That is something that can reduce any kind of income that you may have, or just count as an expense for the corporation. And that would reduce your taxable income. A credit is very different. A credit actually reduces your tax liability dollar for dollar. Now, even if you don't have a tax liability, you can generate credits, and those credits can be carried forward into future years when you might have a tax liability. For our clients that are small emerging tech companies, what we find are most appealing to them and apply in most cases is an R&D tax credit. So for research and development costs, the IRS has a very detailed description of what kind of expenses qualify for research and development costs. And we typically will do a general categorization of those costs to get them on the tax return. And then if you become profitable and you actually want to claim that credit, we might go back and do a more detailed analysis so that you can actually sustain an IRS audit as claiming that R&D tax credit. R&D tax credits, just so you know, are routinely challenged by the IRS. So if you are going to claim that credit, you want to make sure that you've used a reputable firm that has done a detailed analysis of what might qualify for that R&D tax credit. The other item that's out there is something that's called the enterprise zone credit. I know I was surprised my first study in the enterprise zone credit because of the nature of the credit, just how much you can claim. You can actually, if you've got one employee that cost you $60,000 and you happen to be headquartered in an enterprise zone, then you can Google enterprise zone. In California, there's any number of enterprise zones. Here in the Bay Area, give you an example, anything south of Market is basically an enterprise zone, and there's still some areas north of Market that are enterprise zones. Same is true in some places in Southern California. So if you happen to be in an enterprise zone, you can do what's called vouching an employee, which means that you take all of the details about the employee that you've hired, you submit it to the municipality where you happen to be headquartered, where your business is located, and they will go through a process where they determine, yes, this employee qualifies for the enterprise zone credit. It's a state credit here in California, and they've changed the rules a little bit. It's not quite as liberal as it once was. There's still dollars out there to be claimed. Be timely, so you need to do this year if you wanted to claim a credit for employees hired in this year. You can actually get a total recoup of 1 year's salary for an employee over the course of the next 5 years. So you can't claim it all at once. And remember, this is a credit, so you actually have to have tax liability to use this credit. The downside is it costs a little bit of money to get that employee qualified and vouched, but it's a nice sizable credit. So the other things to be concerned about, most of these things apply to profitable enterprises. So if you do have profits, you're going to have a requirement to make an estimated quarterly tax payment and an estimated filing that is giving an estimate of what your taxable income is. So those are the primary income tax requirements.
Just quickly to expand on what Glenn was saying, it's possible to have zero income or losses and not have to, not feel that you're impelled to file a federal return. Yet many states, if not most states, require some kind of a minimum tax. And if you don't pay that minimum tax, not only will you potentially lose your good standing, but you can lose any licenses that you're required to have in order to operate if your business requires a specialized license from the state. So that's one thing to be aware of. And the other thing is, Glenn correctly pointed out that calendar year corporations have until March 15th, but if you're June 30th, be aware of 2.5 months, which would be September 15th.
Yeah, I mean, that's a good point, Mike. The general rule is that the filing deadline is 2.5 months after whatever your fiscal year end is. Most people have a 12/31 calendar and fiscal year end. And also to follow on to Mike's other comment, the $800 minimum fee for California, the filing deadline for 12/31 year end is March 15th, but the payment, so just something you might be a little bit concerned about.
You cut out there for a second, Glenn. Can you repeat that last sentence?
Oh, I'm sorry. I was just saying that you might be concerned about when you have to file your $800 payment to California. It's not due until April.
Perfect. Thank you.
Now we're getting into the kind of things that we consider to be tax compliance and registration issues. So as I mentioned earlier, there's a Delaware filing. For those of you that are registered in Delaware, that was on February 28th. And if you did not make that filing, you can still do so. It's important to do so. There'll be a small penalty for failing to file timely, but it's not that significant. Then the next thing that is important from a compliance standpoint, and we frequently have clients that miss this, is it depends on where you're located as to whether or not you need to be registered to do business in that location. So for instance, if you happen to be in San Francisco, you need to register with the city of San Francisco. Most occasions, the tax liability for startups in San Francisco is minimal. They do it based on payroll right now. There's also a tax for the amount of assets that you have on hand. But for small startups, that's very negligible, if any kind of a cost, but you do need to be registered. So once again, the thing that dictates where you need to be registered is where is your corporate headquarters. And then you can easily find out whether or not you need to be registered or not. The next thing that applies to most of our clients is when you have independent contractors. And Mike's going to talk a bit about the difference between employee and independent contractors, which is a very important point. From my standpoint, the only thing I'm going to mention is that when you do have independent contractors, there is a requirement to file what's called a 1099. You probably have already gone through that because the deadline for that was February 28th to get the form to the IRS. And good business practice is that you get a W-9 on file. So you can Google W-9. It's a very simple form. It's a fillable PDF that you can access over the internet. But if you ever get audited by the IRS, they're going to want to see a W-9 on file for all of your independent contractors. It basically says this is their name, this is their tax ID number, and this is their address. It's required for anyone who is not a corporation who you've used as an independent contractor and paid, I believe, $600 is the threshold. So good business practice is before you make that first payment, get a W-9 on file, and then you'll be in good position to file the 1099s when they're due at the end of the year.
And expanding on what Glenn was saying, you have to ask yourself, do you want these people to be independent contractors? Now, there are people who are providing services for you who provide services for many companies, and they're clearly independent contractors. And then there are some people who only work for you, whose work you control, perhaps whose hours you set, whose where they report to work you determine. Those sound more like employees than independent contractors. The downside is if you're not paying the employer's portion of their employment taxes as independent contractors and you make them employees, you're going to have to, it's going to cost you a little bit more out of pocket, but you're going to have the peace of mind of knowing that the IRS and the state franchise tax board, the state employment development department, and even the state workers' comp board will not challenge your classification. And some of the California state agencies have stepped up their scrutiny of the treatment of independent contractors. So if you have a full-time exclusive independent contractor, you may want to determine whether he or she is actually an employee. Glenn?
Yeah, well, I was just going to say on foreign contractors, this question comes up all the time. If you have independent contractors that are foreign nationals and are located outside the United States, you do not have an obligation to file a 1099 for those folks. However, if they're foreign nationals and they reside inside the United States, you do have to get, it's called a W-9-BEN, I believe. It might be a W-8-BEN. But there is a filing, and there's a requirement to actually withhold a certain amount of what you pay those foreign nationals who are located inside the U.S. Okay, Mike's going to talk a bit about payroll. All I wanted to say is that we advise clients all the time about what type of payroll system is most appropriate for them. You can go anywhere from a very low cost approach to payroll, which is using for payroll processing. There's any number of services. ADP even has a low cost service. All the way up to the high end, where you could have what's called a PEO, or a professional employment organization running payroll and human resources for you. So we often talk to our clients about what situation is most important to them. And Mike's got a number of comments along these lines.
Thanks. The payroll tax system has both filing requirements and payment requirements. And unlike the income tax system, the payment requirements are not linked to the filing requirements. Most employers have to make federal tax deposits. They have to make them electronically. Just mailing in a check is not sufficient anymore for most businesses. You have to make an electronic funds transfer to the IRS, usually within 2 business days of the end of after a payroll. You have to file a quarterly employment tax return with the IRS and an analogous filing with the Employment Development Department of the state of California. There are penalties for failing to deposit taxes. There are penalties for late filing of the quarterly returns. Even if you're using an outside payroll service, they may only be filing the quarterly tax returns. You may still have retained the obligation to make payments. And if you're not using a reputable payment service, you may find, as occasionally happens, that somebody's absconded with your money. So you need to be diligent about the performance of your payroll service as well. There is potential personal liability for failing to collect and pay over employment taxes from your employees. If you've ever been involved in a struggling company, the temptation may be not to pay payroll taxes, but to pay utilities, pay suppliers, with a view towards getting things straightened out, working out the cash flow problem, and then paying the taxing agency later. It's a big gamble because if you're wrong, there can be personal liability for whoever is, quote, a responsible officer of the company. And that can include investors who have a big say, board members who had a say in that determination, as well as officers and even employees who have power over check writing. So be very careful. If the company doesn't file its tax returns, then the IRS has the authority to file a substitute for return. Doing that usually means that they will use the prior quarter's numbers, and if the company is contracting, that will result in a tax liability that's much higher than it should have been if the return had been filed, because they'll be using numbers that reflected a great number of employees and a higher payroll. Glenn?
I didn't have any to add on.
Okay.
Here on compensation issues, this is near and dear to the heart of most of our clients who are startups. And obviously, stock options are something that is a great motivator for getting great talent to want to align their interests with the company's interests. And it's a great way to retain your talent. So there are any number of strategies that you can deploy when looking at using stock-based compensation, and Mike's going to talk on the beginning parts of these issues.
Okay, there's two kinds of options that a corporation can issue, and those are incentive stock options and non-qualified options. Under current rules in effect, options have to be issued at market or above market. They cannot be issued in the money. That creates first of all, it causes them not to be incentive stock options, and even for the non-qualified options, it creates income tax inclusion for the employee. It's simply not worth going there. Incentive stock options don't result in ordinary income on exercise, and if the stock is held for a year, they result in capital gain for the service provider. Non-qualified options result in income on exercise of the option, and then if the stock is held for a year, capital gain. Most of the time in practice, non-qualified options aren't exercised until the company either goes public or is about to be acquired, so there's usually compensation income for the employee and offsetting compensation deduction for the company. Incentive stock options create income for the alternative minimum tax. It's sometimes called an item of tax preference. The alternative minimum tax for single individuals kicks in after $52,800 worth of alternative minimum taxable income. So it may be possible in conferring with your own personal tax advisor to determine whether and how much incentive stock options can be exercised each year without triggering the alternative minimum tax, which is basically a flat tax that kicks in at 25% and then jumps to 28%. Profits interests are available for entities taxed as partnerships, LLCs, limited partnerships, and general partnerships. And basically what they say is, if you take a snapshot of the value of the company and issue an interest that on the day of issuance would be worth zero, then the profits interest is not a taxable event on issuance. So if your company is worth $10 million when a profits interest is issued, and the terms of the profits interest are, if that's the base value, and the terms of the profits interest are that it doesn't participate until cumulative distributions equal to the base value have been paid to the pre-existing members, then the issuance of that profits interest is tax-free. And that's only half the benefit. The other half of the benefit is that the holder of the profits interest gets the same flavor of income as the other members of the partnership or LLC. So that if the company sells a line of business or sells all its assets, that's going to be the same kind of income that the holders, the other holders have received, and it could well be long-term capital gain. Restricted stock, and there's two kinds of restricted stock in popular nomenclature, but they're pretty much the same thing. One kind, you earn it as you perform the restrictions, and the other kind, you get the stock, but it's subject to divestiture if you don't perform the restrictions. In either case, the general rule under Section 83A is that it's income when the restrictions lapse, when the restrictions have been met. What most people do is they follow Section 83B, and within 30 days of receipt of restricted stock, elect to treat the value in income on the date of receipt. So it's valuable in a startup company. You get stock. You may not be able to keep it unless you work for the company for a period of years, or unless you hit numbers, or unless you perform in some other way. But it's a way to get that stock on a relatively inexpensive tax method. You file an 83B election. It's not a specific form. It's one that Glenn or I could help you with. It's usually a one-page form that just explains what the restrictions are, what the value is, and what's being reported. A copy is given to the company, and the original is filed with the IRS within 30 days. And the restrictions are typically vesting, but there can be other restrictions that may even be beyond the control of the employee that would cause the employee to lose the stock if those restrictions aren't met. Finally, Section 409A is I'll call it a pervasive regulatory scheme that covers most aspects of deferred compensation. That can involve anything from the company holding money for the employee to issuing options that are in the money, a deferred bonus plan. Many of these things have to be run through Section 409A, which is complicated enough, and the regulations under Section 409A, which probably account for 20 pages of very complicated rules and restrictions. One of the things that's a practical issue that people do is when options are being issued to key executives, there's a safe harbor if the value of the company is determined by an independent qualified appraiser. I contacted an appraiser with whom I've dealt before, and he said that the ballpark for a 409A appraisal is usually in the $8,000 to $20,000 range, depending on whether the company has recently done a financing or not. And by obtaining an appraisal, you fall into a safe harbor so that if it turns out that the company was undervalued and the options were actually issued in the money, there won't be penalties for both sides.
I will tell you folks, just to take the shock value out for anybody who has to do a 409A, Um, our firm does provide 409A services, and our pricing is more along the lines of 4,000 for a startup seed stage, and it goes up from there. So it's not always 8 to 20,000. But the thing I just wanted to mention to you is the reason you need a 409A, and Mike alluded to this, is that you don't want to have a taxable event to your employees just by virtue of the fact that you've given them stock options. And so you have to establish the fair market value of one per share common stock. And that price then becomes the exercise price for your options. The requirement for a 409A study is basically you need one pretty much coterminous with when you're issuing your options the first time around, and then you need to refresh that 409A study every 12 months if you plan on continuing to issue stock options. 409A can be very complicated, as Mike said, and if you've got any questions along those lines, feel free to reach out to us after this presentation. So, first of all, for most startups, you're not at the stage where you're dealing with sales tax. One thing we want to leave you with is that you can't use a rule of thumb to apply to sales tax in every municipality. Sales taxes are complicated, and the reason is every state has their own rules, and some states have their own rules within the municipalities of that state. Those rules apply to different tax rates, different items that are taxable, and these rules are changing as we speak. Some states are being very aggressive and looking at taxing services. Now, there's a concept in sales tax called nexus, and anytime you're trying to evaluate whether or not sales tax applies to your company and what you do, the first starting point is, do you have a nexus with that sales tax municipality or state? Nexus is based on where you're headquartered, where your company is headquartered. So in California, you're going to have a nexus on any sale in the state of California. The next question is the service or product that you're selling susceptible to sales tax? So as most people know, products are taxed. I know most people are probably aware of the whole Netflix issue, which is, hey, if I have a subscription to Netflix, is that really a product? Well, the reality is the states have determined that, yes, that is a product and should be taxed. You might think of it, well, there's no physical item here, but the states tend to look at these things differently than individuals would. The next thing to think about when it comes to sales tax is that filing requirements are different than payment requirements. So when you've got an individual, there are a number of applications out there that can be connected to shopping carts where you can calculate the tax due on a particular location. Well, that's great. You've now collected the tax from the customer. You're holding on to that dollar. Now, how do you get that money to the taxing authority? So actually filling out the tax form and complying with the tax filing obligations as well as remitting those taxes to the states, that's different, and that's more difficult than it is collecting those taxes. And there are no really good web-based applications for doing that. So the task of being in compliance with sales tax is not necessarily an easy thing to get your hands around.
Thanks, Glenn. And I would just add that in expanding on what he was mentioning about the different jurisdictions having their own rules, I read a ruling yesterday out of New York where a minister who had her own corporation and would provide sermons and counseling at different churches, and they would hire her S-Corp, had to go and get a ruling that the provision of religious ministerial services was not taxable under the sales tax rules in the state of New York. So many jurisdictions are becoming very aggressive in this area. In California, if you dissolve a corporation and it owes sales tax at the time that it's terminated, the state of California will attempt to determine who are the responsible persons of that corporation, similar to the inquiry that's done when a company isn't paying payroll taxes. So it's best to, if a company is being terminated, to make sure that the final sales taxes returns are filed and fully paid.
Okay, Mike's an attorney, and so we each have our own view of what kind of mistakes can happen that we've seen clients make that we've tried to help them with. And so we each have kind of bullet points here that we're going to touch on. From my standpoint, I think the number one thing that I think if I could leave and impress upon my startup audience here is that you definitely want to separate your business and your personal finances. Almost every startup that we run across gets started from day one by financing their business activities out of their personal account. If you're one of those startups that on day one started a bank account in your corporate name and you contributed a sum of money into that bank account, congratulations. You are in the minority, and that's the best way to handle it. So if you haven't done that yet, we strongly encourage you to get a bank account and credit cards in the names of your corporation or your business so that you've got some segregation between your own business finances. That can be the hardest thing to separate and get clean financials so that you can file your tax returns. The other item is not identifying and deducting business expenses. You should be aware of the kinds of expenses that your business is incurring and realize that you can reduce future tax liabilities by itemizing and deducting those expenses. And then the last thing I would leave you with is using the wrong tools or systems or not using any. Lots of folks who are in the early stages will be keeping track of their expenses in Excel because all they really need to know is, hey, how much money do I have in the bank? We're going to kind of keep track and keep our eye on these expenses, but that's not going to be able to result in a tax return being prepared. You really actually need a general ledger system to be set up and running your expenses and your business items through that general ledger so that you can be prepared to file your tax returns.
And I would expand on that by noting that it's not only important for tax compliance, but if your startup's exit strategy is to be acquired by a bigger fish, that bigger fish is going to do diligence on you. And if the accounting methods you've used are inscrutable, it's just going to be that much harder than if you've used something that will make what you've done integrate easily into their accounting and reporting system, especially if they're a public company and they have to translate what you've done in Excel into their GAAP. So everything Glenn said is very important, not just for tax purposes, but for the future development of your company and ultimately your exit strategy. Most of this is a summation, choosing the wrong legal entity. And more important than choosing the wrong legal entity is not choosing an entity, running it as a sole proprietorship. If you set up an entity, you're more likely to also have separate accounting for that entity, separate bank accounts for that entity, and as a result, take care of separating the business and personal finances. Paying quarterly taxes, very important. We've emphasized that in the sales tax area and the employment tax area. And for yourself, once your company starts making money, it's important to remember if you're either a sole proprietor, a member of an S Corp, or a member of an LLC or partnership that you want to make quarterly income tax payments, it is often a problem where after several years of running successfully, things start to go sour, and you owe a bunch of money to the IRS and the FTB for those good years, and now you don't have it in the bad years. And you didn't have the money because you had to pay a bunch of expenses, and now you owe a bunch of money to the IRS. It can affect what happens with your business, because now you're going to be under pressure to sell it out maybe before you would have liked to.
Okay, the only thing that I'm going to say in terms of professional tax expertise is, thinking about it from both the legal and accounting side. Michael talked on the legal side, but we see that some of the clients that we bring on the tax side may have been working with people who don't really understand small startup issues, and that's important both when you're looking at the types of credits that are available. But also in terms of tax planning, segregation of expenses, thinking about planning for credits that you might be claiming down the road, as well as being in a position to support clients who are going to go through an IRS audit. You want to make sure that whoever you're using has been through the wars of an audit before, and not just handling personal tax returns.
And my point would be, in summation, that you would want a legal partner who not only knows tax, but is part of a group that has insights in the mergers and acquisition area and in public securities offerings, so that you can call on a multidisciplinary approach if needed. Thank you.
So that is our presentation for you guys today. Thank you so much for joining us. If anyone has any questions, feel free to enter it in the question field in your control panel, and we can go ahead and get those questions answered. Otherwise, here is Glenn and Michael's contact information, and you're more than welcome to follow up with them individually. We have a question from the audience. It says, we work from Menlo Park, California, but incorporated in early January 2013 in Delaware. If I understand correctly, do we have to pay the $800 minimum California franchise tax for the first time this April 15th?
Yes, and that'll apply to 2014. So I believe, and Mike, you can correct me if I'm wrong, but I believe that you don't necessarily have to pay that first year that you're incorporated. Is that correct?
I believe if you incorporated in the last 2 weeks of December, they give you a safe harbor. If you're qualifying to do business in California, and you're going to be filing a tax return in California, then you're going to need to qualify. They don't allow a whole lot of wiggle room, at least from the legal point of view. I mean, Glenn, if your practical word of experience is that people just don't file them for the first year, then that's a different story. But yeah, April 15th is when the
If you're based in California, you need to be registered in the state of California. And if you're registered in Delaware, that's just, unless you happen to be located in Delaware, that's not the extent of your filing obligations. If you worked with an attorney, you should reach out to that attorney and ask them, did you get registered in California as well? But there's a whole filing process that you need to go through as a corporation in California. It includes filing a fictitious business name in the municipality that you're located in, registering with the state of California, with the Secretary of State, getting a corporation number. If you're going to have employees in California, you got to register with the EDD, the Economic Development Department. There's a lot of requirements that go with running a business in California. So I suggest if you have an attorney, you reach out to that attorney. If not, you can either research it yourself or reach out to us, and we can help you understand your obligations.
Absolutely.
Our next question from the audience is, what ledger systems would you recommend for keeping track of our financials?
That's a great question. I guess the question depends on how aggressive you plan to grow as a business. Do you plan to seek venture capital investing? Do you have a requirement? What we see is that when you have professional investors as part of your investment team, that you're going to need to require monthly financial statements in accordance with generally accepted accounting principles known as GAAP. If you don't have professional investors, let's say you have angel investors, or if it's just bootstrapped capital, very often you don't need to provide GAAP financials, and you should have a clean accounting system. So, we've had clients that have worked with Wave, which is a very low cost, easy to use accounting system. There's Xero out there that I've seen clients use. We really don't like Xero because it's hard to convert from Xero, which is a cash basis. It's really easy to use if you're a founder in a startup. It's just very hard to convert from cash basis to accrual basis when you're using Xero, but it can work. We see most of our clients that have done it themselves using QuickBooks Online, but that requires a little bit of knowledge with ability to dig in a little bit into how to work with QuickBooks Online. It's user friendly and it's inexpensive, so that's what we see a lot of folks using. Personally, our firm uses QuickBooks Enterprise, and QuickBooks the Enterprise version can fulfill the needs of most clients. When you get into manufacturing and other kinds of operations like that, you'll move past the abilities of QuickBooks Enterprise. But in general, I would say that Wave and QuickBooks Online are probably the best answer for very small startups.
Perfect. It looks like that is all of our questions for now. Feel free to email Glenn or Michael directly with any follow-up questions. And like I mentioned at the beginning, this presentation as well as the slides will be available on SlideShare and our YouTube channel. You guys enjoyed the presentation this afternoon, and will be able to join us for upcoming webinars soon. Have a great day.
Thanks, everyone.
Thank you. Bye-bye.